Hello, everyone, and welcome to Answers with Angel. If you're new here, my name is Angel. I'm a chartered accountant, a finance professional, and a personal finance educator. On this channel, we talk about money in a way that is simple, very practical, very demure, very relatable. And we've started an investing series for beginners. So far, we've looked at what investing is not, what investing is, and even the different asset classes that you can invest in. And today, we're taking it a notch higher. So today we're talking about how to actually start investing as a beginner, because it's one thing to hear about how to invest. It's one thing to hear about what investing is not, the different asset classes. But taking the first step is what really changes your financial future. And today we're talking about investing in the context of stocks and shares and equities, whichever one you prefer, because that's actually the main one that normal people like you and I can unlock very easily. It's accessible, it's relatively low risk. You can start with as little as even £1. Usually, when people talk about investing, they're talking, I want to buy Apple or Tesla. So today we're going to be talking about how to invest as a beginner. And just a quick disclaimer, this is not personal financial advice. Always do your due diligence before investing anything. Now let's start with an important question. Why should you invest? I talked about this briefly in Investing 101 about how it's important to invest to hedge against inflation. This is true because saving alone will not build wealth. And such a stand of savings. I mentioned how that in 2024, my main goal was just to build savings. Savings is very important. It's very good to save. It helps you build emergency funds. It helps you to manage short-term needs. But if your money is just sitting in a savings account, something called inflation will slowly creep in and reduce its value over time. So if you've kept like £100 or 200,000 naira in the savings account today, it may not have the same purchasing power in 10 years, even tomorrow, because the way prices of goods and services actually increase rapidly, 10 years might actually be even too much. So you want to ensure that you are hedging against inflation. Investing helps your money grow faster than inflation. That's how wealth is built. Now let's talk about the fears that people face when it comes to investing. Let's be honest. For many people, investing feels scary. And I totally understand. Our natural instinct is to hold cash, is to keep money in our account, right? Especially with the background that most of us have. But the truth is, the biggest risk that you'll be taking long term is not investing at all. And before we talk about how to invest, let's talk about the two biggest fears that stop people from investing. The first one is the fear of losing money, which is very valid. Investing involves risk. And now you worked hard all the year, you've saved your money, and you're putting your hard earned money into somewhere that you can't control. You can control your expenses. You can decide today that, oh, I don't want to pay my Netflix subscription. I'm done with Netflix. Oh, I'm done with this data subscription. I want to do something lower. You can control your expenses. You can control your bills, right? But not investing. But here's something to understand. As much as investment is risky, not all investments carry the same level of risk. There's some investments that have higher risk than others. In the last video, we looked at the different asset classes to invest in. We talked about cash, we talked about stocks, we talked about bonds, we talked about property. On the risk scale, individual stocks tend to be high risk, right? But equity mutual funds or ETFs are moderate risk, while bonds are generally lower risk. Life itself is a risk, right? But do you say because it's a risk, I'm not doing this thing called life again? You dare not. So the goal is not to avoid risk completely. The goal is to manage risk wisely based on your comfort level. So you need to invest based on your risk appetite. It's very important. What's your risk appetite? So that's the first one, fear of losing money. The next one is not understanding investing. This is another thing that stops people from investing. The fear of not understanding how it works. Again, the finance industry, the finance sector has a lot of jargons. You hear words like ETFs, you hear words like dividends, index funds, market volatility, And it can be very overwhelming. I promise you. Especially because you have a life outside investing. You're trying to make a living out of your 9 to 5 or even your 9 to 9. But the truth is, investing is simpler than it looks. And today, I want to show you a very simple way that beginners can start investing without needing to be finance experts. You just need to know the basics. But before we go right into how to invest, let's talk about something that often sounds complicated, but is actually very simple: the stock market. I like to think of it this way. Just like you walk into a grocery store to buy groceries, or you go to the salon to get your hair done, the stock market is simply a place where people buy and sell ownership in companies. That's it. It's a marketplace. It's a platform. You can't walk into Apple office today and say, hey, I want to be a part owner. I want to have ownership in your company. No, it's different. There's something called a middleman. There's a stock exchange where we can trade stocks, where we can buy and sell stock. Remember what we discussed in the previous video? When you buy a stock, you're buying a small piece of a company. You're buying a percentage ownership in that company. You are a part owner. There are two main ways you can make money from stocks. Number one, price growth. Say you bought shares in Apple 5 years ago. The price of Apple in 2021 was between $120 to $140 per share. But as of today, when I'm recording this video, it's around $250 to $255 per share. It means that Apple stock has delivered a total return of approximately over 100%. So 102 to 114% over this period. A lot has happened in Apple over the last 5 years since 2021. I think the model that was released in 2021 was the iPhone 13. We've had the iPhone 14, we've had the iPhone 15, we've had the iPhone 16, and now we have iPhone 17. We've seen the pivots to Apple Intelligence and what have you. All of these affect the performance of Apple, right? All of this contributes to the success or to the financial performance of Apple. Price of your shares, the value of your shares can increase, and say maybe in another 5-10 years, you can sell it. That's price growth. Another way you can make money from stocks is through dividends. Some companies share part of their profits with investors, and these payments are called dividends. Not every company pays dividends, so you want to ensure that you do your due diligence if that's something you're looking for in investing. Now, let's answer the big question: what should I buy? Should I start by picking individual stocks? Oh, I'm familiar with Unilever, Tesla, Amazon, even Apple. I mean, I use an iPhone, I have a Mac, I have AirPods. As a beginner, I would say no to buying individual stocks. Don't rush into buying in or investing in individual stocks because you're familiar with the names or the product, or you have a colleague working in that company. Individual stocks can be risky. And if you're starting out as a beginner, you want to start with investments that are less risky and more diversified. A company that is successful today might not necessarily dominate its industry forever. Market evolves, technology changes, consumer preferences even shift. For example, think about companies like Kodak. For decades, Kodak dominated the photography industry, and almost everyone used Kodak films. Almost everyone used the cameras. I'm not sure some of us can remember. But when digital photography emerged, Kodak struggled to adapt quickly enough, and its market dominance declined. Another example is Blockbuster. Blockbuster was once the largest video rental company in the world, and people used to physically visit stores to rent movies. I'm sure we can remember those days. But now we've seen the rise of digital streaming platforms that have completely disrupted that business model. Today, companies like Netflix, Disney, they've changed how people watch television, people watch movies. Now, this shows an important lesson in investing, that even companies that seem dominant today may not remain dominant forever. So, betting all your money on one company as a beginner can be risky. A safe and simple strategy for beginners is to invest in an index fund. We talked about index fund in the last video, but let's break down index fund now. So take funds as a basket of stocks. Why the index component means this fund tracks a particular stock market. So index funds allows you to invest in many companies at once. It helps you to spread your risk. Now, one of the most popular indexes in the world is the S&P 500. This index tracks the top 500 companies in the United States. When you invest in an S&P 500 index fund, your money is spread across about 500 companies across different sectors, across different industries, including Apple, Microsoft, Amazon, Google, Nvidia, Meta, Tesla, IBM, Ralph Lauren, etc. I think it's just simple. Like, instead of trying to guess which single company will win in the future, you can't predict the market. Even the best of the best finance experts, sometimes they get it wrong. It's just advisable as a beginner to invest in the overall market. And let's talk about diversification. So I want you to think of a scenario, say you want to get fruits for me. You don't know my favorite fruits. You don't know if I like apples. You don't know if I like mangoes. You don't know if I'm allergic to any fruit. But if you buy me a basket of fruits that contains apples, mangoes, oranges, grapes, strawberry, banana, out of the basket of fruit, it's certain that my favorite fruit will be included. Like, there's no how. That's basically what diversification is. It simply means spreading your investment across different assets. It's one of the most important principles in investing. Now, let's talk about the practical steps. How do you actually start investing? This is where a lot of beginners get stuck. A lot of people ask questions, oh, should I buy Apple? Should I buy Tesla? And before you know it, they get overwhelmed, with the decisions, and they eventually end up not buying anything at all. I'm going to run you through 5 things to do to actually get on your investment journey. The first thing you need to do is to choose an investment platform. You want to get an investing, you want to start your investing journey. First, you need a platform where you can buy investments. Like I said, you need a middleman. You can't just walk into Apple, you can just walk into Google Office or Meta and say you want to buy stocks. You have to sign up on a brokerage platform. There's so many popular options of brokerage platforms. In the UK, you have platforms like Trading 212, you have Vanguard, you have eToro, AJ Bell, Agris, Lansdowne, HO for short. That's the first thing you need to do. Choose a platform where you can buy investments. And when you're choosing a platform, is look out for the regulation, look out for the fees, ensure that you're picking a platform with low fees, because at the end of the day, you don't want the fees, the management fees of this platform to eat into your little profits. So you want to check the fees. You also want to check the interface. Is it easy to use? Is it beginner friendly? If the interface is confusing you, to run. There are some investment platforms that I find really scary and very complicated. I personally use Trading 212 and I totally recommend. This is not a sponsored video, by the way. It's just a personal preference. Step 2 is open the right type of account. In the UK, we have different types of investment accounts. The common one is the stocks and shares ISA. ISA stands for individual savings accounts, and this account allows your investments or your savings to grow tax-free up to the annual allowance, which is currently £20,000. It only applies to residents in the UK. So if you're in the UK and you're eligible, this is usually a smart place to start. You have other accounts like the general investment accounts. Under the general investment account, it's just a standard investment account that does not have the tax advantage of an ISA, meaning if you invest £100 today and you make a gain of, say, £20, your £20 is liable to tax. You also have the SIPP account, which is the self-invested personal pension. It's a pension account that is designed for retirement investing, so you can only access that money after you've retired. So now you've done the first step, which is to choose your investment account. You have opened the right account. The next thing is to deposit money. Here's something that's very important. It doesn't just stop at depositing money into your account. If you deposit money into your account and you don't do anything, you don't invest, you don't actually put that money to make more money for you, which is actually the point of investing, it means you've not invested yet. It's as good as just putting money in your bank account, but this time without any interest on your savings. So you still need to choose investments, which brings us to the next step. Step 4 is choose an investment. A simple starting point for beginners is a global index ETF, like the FTSE Global All Cap Index, which tracks the global market. This type of investment spreads your money across thousands of companies worldwide. You're not just looking at US, you're looking at Japan, you're looking at UK, you're looking at Asia, you're looking at Europe, you're looking at Canada. It's diversified and beginner friendly. Global index ETF is always a good place to start. Lastly, invest consistently. Choosing your investment platform, open a right account, deposited money, choosing an investment. The next thing you want to do is don't just stop there. Invest consistently. That's the next key habit that you want to build. Instead of trying to time the market, invest regularly. For example, you can decide, okay, every month I'm going to be investing this amount. Every quarter, I'm going to be investing this amount. And the way you can ensure that you build this habit of consistency is through automation. Automate this through your bank. Use a direct debit Use a standing order so that at the end of the month, you're not trying to debate, oh, should I invest? Should I not? You're not trying to think about it twice. The money has left the account. This strategy is called dollar cost averaging. If you've never heard of DCA, DCA is a strategy of investing money in the market little by little over time, as opposed to investing all your money at once. It means you invest consistent, whether the market is high, whether the market is low, whether it is green, it is red, you're investing. This helps you as a beginner investor to limit risk and to limit volatility. The stock market would always go up and down. There would always be recessions. There would always be market crashes. There would always be wars. No one is praying for anything, but we're literally seeing it in our days. There would always be economic uncertainty. The market would always fluctuate in the short term, but historically, we've seen the market grow over long periods of time. There have been major crises. We had the financial crisis in 2008. We had the COVID-19 pandemic in 2020. And yet the market has continued to recover and grow over time. So at the end of the day, you're thinking long term. You need to tell yourself, I am a long-term investor. You need to actually make some certain confessions. I am a long-term investor. You're not going to focus so much on the daily market movements. You're going to focus more on time in the market. Because when you give your investment a lot of time, the compounding effect begins to work in your favor. If you're taking one thing from this video, let it be that you know that investing is not about being perfect. It's about being consistent. It's about being patient. It's about starting small, invest regularly, stay diversified, think long term, give your investment time to grow as well. If you found this video helpful, make sure that you catch up on the earlier videos in this series. And if you'd like a video specifically about investing from Nigeria or investing in the Nigerian stock market, please let me know in the comment. That's something I'm also learning as well to do, because I've always been anti Nigerian stock market, but now I'm learning more about it. I'm learning about it and I'm trying to also invest. So ensure that you catch up on the previous videos in this investing for beginners series. And don't forget to like this video, subscribe, and share this with someone who wants to start investing but doesn't know where to begin. And I'll see you in the next class. Bye.